Larry Williams is one of the great short-term traders of our generation. He's still trading, he's very successful, and he wrote many books about the subject. I featured many of his strategies on this channel, and most of them are based on his very successful book, Long-Term Secrets to Short-Term Trading. In today's video, I will add another strategy from his book that is based on his indicator that is called Will Spread to give a signal when to enter a market based on a related market. So for example, let's take the S&P 500 and bonds. These two markets are interrelated and they affect each other. So Will Spread take the ratio between these two markets movements and give a signal for entry and exit. So here I have the S&P 500 represented by the SPY ETF and the long-term treasuries represented by the TLT ETF. So if we divide the close of the S&P 500 by the close of TLT, we will get this spread. Then we built two exponential moving averages on this spread. One is fast and one is slow. And if we deduct the fast exponential moving average from the slow exponential moving average, then we will get this oscillator. The oscillator will hover above and below zero. When it is above zero, that means the main instrument is performing better than the related instrument. Now, once we have this oscillator, it's just like a MACD. Then we can add a signal and an average of that signal, and we can take the cross of that signal and so on and so forth. You can watch my MACD video to build strategies using this indicator. But in this video, I will use the pure Will Spread indicator to take the signal. So we do that by simply going long on the S&P 500 whenever the spread is above zero. So for example, let's take the cross from red to green here. You can see that now the S&P 500 is moving up while the TLT is moving down. And that's why we have the green oscillator going up. Also notice that when the S&P 500 is doing nothing or moving down slowly, while the TLT moving down quickly, we also see the green moving up. And that's when I say it's relative. So we are just measuring the performance of these two instruments. If the performance of the S&P 500 is better than the performance of TLT, then the oscillator will move up. And of course, the opposite is true. So now let's test this strategy that we will go long the S&P 500 whenever we switch to green. Now, since I am applying this strategy to ETFs, the position sizing is working by using the full account. So I'm using the maximum amount that I can purchase at any moment in time. And if we check the performance, we are making $1,500, but that's of course not good. We have 117 trades on average making $13. So this is purely by using the crossover from negative to positive and exiting after 5 number of bars. Now I'm going to keep this open and I am just going to switch another exit, which is if the RSI2 above 65. This is a very robust exit. I use it a lot in my short-term strategies, and I will compile now with that exit combined with the 5 bars exit. So now we have a little bit more trades, so 125, but our average win goes to $30, which is still not good, but let's say a little bit better than the other exit. Okay, so now I'm gonna run an optimization to see the best numbers that we can get. So remember, we have the fast exponential moving average is 5. I will set it between 3 and 10. The slow is 20, and I will set it between 12 and 30. The number of bars to exit between 2 and 15, and I will switch on the stop loss 1 and 3, profit target 1 and 3 instead of 0.5. Remember, the stop loss and profit target are a multiplier of the average true range. So that should give us about 53,000 combinations. And let's run and see the results. And sorting by the return to drawdown ratio, this is the best result, which is 10 and 27. That's the fast exponential moving average and the slow exponential moving average. So profit target is 1 ATR and stop loss is 2.5 ATR. So that means we are hitting the profit target a lot more than we're hitting the stop loss. So let me double click on this to get these values, and let's see the equity curve. So we have 70 trades making 500 average. So this is a huge improvement to the strategy, and the curve is really good, and we can see the drawdown in dollars is about $10,000 here. But of course, this is the best result, and most likely it is an overfit, and I wouldn't bother even with trying to find a suitable range, because even with the best performing numbers, I don't like this strategy for now. And that is very important to keep in mind. You don't have to accept any strategy just because it works. You need to pick the best strategies. And as algo traders, we have the luxury today to pick the best strategy, because we can develop thousands of strategies easily with optimization or with data mining packages. And so we don't need to stick around with any so-so mediocre strategy. Now, probably you have figured out that this can be also switched to pair trading, because at the end of the day, we are measuring the relative performance between two instruments. So how about applying this to pair trading, which is bringing two companies that they are in the same market and buying the best performing one. So now the same strategy is applied to Pepsi and Coca-Cola. So Pepsi and Coca-Cola, of course, are in the same industry, in the same group. And here on the top is Pepsi, at the bottom is Coca-Cola. So when with the oscillator is green, that means Pepsi is performing better than Coke. And when it is red, that means Coke is performing better than Pepsi. And we do the same. We buy when it switches to green, and we have our profit target, stop loss, and number of bars. So in this case, the fast exponential moving average is 8 periods. The slow exponential moving average is 12 periods, 3 bars to exit, 2.5 ATRs for stop loss, 1 ATR for profit target. And if we check this strategy, the strategy is performing well with about $10,000 in drawdown, but the performance is now $62,000. And if we check the total trade analysis, about 137 trades with $450 on average. And if we look at the annual period analysis since 2007, we have one down year, which is 2012, and currently this year is also down with 5 trades. Now, of course, you might say this is an overfit, but if we look at all the optimization numbers, if I sort by custom fitness and I keep going down, I'm trying to find 2 to 1. So up to here. So that's about 1,700 strategies that has 2 to 1 return to drawdown ratio. So this is really good. I mean, you can find easily many combinations that will work. I mentioned at the beginning that this oscillator can be just like the MACD, where you can build a signal and an average of the signal, and then you can the cross of two of those signals above 0, below 0, and so on and so forth. But also you can make this oscillator as a filter for other signals. So to illustrate this concept, here I have the S&P 500 with TLT. And now I am buying every Monday and exiting the same way, either number of bars, stop loss, and profit target. So I'm using for wool spread the 3 exponential moving average as fast and 12 exponential moving average as slow, exiting after 6 bars, 2.5 ATR as stop loss, and 3 ATR as the profit target. Remember, I'm not using wool spread to enter. I am buying every Monday. So the strategy is 700 trades, making $560 on average. And we can see the curve. So the curve is very good. And now I'm going to use the oscillator, the wool spread oscillator, as a filter. So instead of buying every Monday, I will only buy every Monday if wool spread is negative. That means the performance of the S&P 500 relative to TLT is low. So let me add the condition and I will compile. So now we have less than half the original trades, But look at our average trade. It went from about 550 to more than double. So that is a huge, huge improvement. If we go back here, we can see that now we're making 358,000 and the curve looks much better now. Remember before it used to be like this and then a hockey stick at the end. Now it's a little bit smoother going up. So as a filter, this also worked really, really well. To watch more of Larry Williams strategies, watch this video and I will see you there.